Netflix stock went from $190 to over $400 in just 1 year, a $110 gain. The catalyst, one TV show, Stranger Things. But here, what Wall Street doesn't want you to know. This wasn't luck. This is a repeatable business model that's made Netflix over $180 billion. Today, I am breaking down exactly how Netflix turns content into cash, why one show can move billion in market cap, and whether Netflix stock is buy, hold, or sell right now. By the end, you will know more about streaming stock than most Wall Street analysts. Today's focus, Netflix. Current price around $400 to $450 depending on when you are watching this. The question everyone's asking, is it overvalued or are we looking at the next Amazon? Stick around for my verdict at the end. Netflix has one primary revenue stream, subscription. They charge users a monthly fee, range from about $7 for basic with ads to $23 for premium 4K. Netflix has over 247 million paid subscribers globally as of their latest earning. Let's do the math. If we take an average of $15 per subscriber per month, 247 million subscribers multiply by $15 average monthly fee, which also multiply by 12 months, which gives us $44.5 billion in annual revenue. So their actually reported revenue about $33 billion last year. So why the difference? Different pricing tiers, regional pricing, and the new ad supported tier bringing in less per users. The content spend problem. Now here's the catch, and this is critically for investors. Netflix spent over $17 billion on content in their latest fiscal year. That's billion with a B. They are spending about half their revenue just on creating and licensing content. Compare that to Apple's 25% plus profit margin or Microsoft's 40% plus margins. Why so much spending? Because they are in arms race. Disney Plus, HBO Max, Prime Video, Apple TV Plus. Everyone's fighting for your attention. And here's the brutal truth. If they stop spending, people cancel. They have to keep creating hits just to maintain subscribers' numbers. This is the treadmill Netflix is running on. Let's talk about why I mentioned Stranger Things in the hook. When season 4 dropped in May 2022, something fascinating happened on Wall Street. Netflix stock jumped 13% in the week following the release. That's about $6 billion added to their market cap from one TV show. Why? There are three reasons. Reason 1, subscriber retention. Industry data show that when a major show launched, cancellation rate dropped dramatically. People who were thinking about canceling, they stick around just to finish this season. Netflix reported that Stranger Things season 4 was viewed for over 1.35 billion hours in its first month. That's engagement keeping subscribers hooked. Reason 2, new subscriber acquisitions. Big shows driven signups. When everyone's talking about a show at work, at school, on social media, so it's create FOMO. People who've been holding out suddenly thinks, okay, I need to see what the hype is about. Industry estimates suggest Stranger Things brought in several millions new subscribers across its various season launches. At $15 per month average, that's million in recurring monthly revenue. International expansion. Here's what most people miss. Stranger Things become a global phenomena. It hits in 93 countries. Why does this matter for investors? Because Netflix growth story is international. The US market is saturated. They have about 75 million US subscribers, and that's barely growing. But they went from 100 million international subscribers to over 170 million in just a few years. Show like Stranger Things, Squid Game, Wednesday, these aren't just entertainment, they are acquisitions tool for international markets. This is the Netflix investment thesis. Create global hits, scale internationally, spread content cost across hundreds of millions of subscribers. Let's look at the actual financials. Whether Netflix is actual good investment, the current price is 400 to 450 dollar and market cap is 180 billion dollar, which create PE ratio 35 to 40. Revenue growth 7 to 8%, which is slowing, but profit margin is 12% and debt is 15 billion dollar. So the good cash flow machine. Despite the high content spend, Netflix is now generating positive free cash flow, about 4 to 5 billion dollar per year. This is huge. For years, they were burning cash. Now they are profitable and generating cash. Pricing power. They rise prices multiple times and people keep paying. That's pricing power, a sign of a strong moat. Last price increase, lost minimal subscriber. That's the kind of brand strength investors love. International growth runway. Massive opportunity in India, Africa, Southeast Asia. These pockets are just getting started with streaming. The bad, slowing growth. Revenue growth has slowed from 20% plus to single digit. That's problem for a stock trading at 35 to 40x earning. High growth companies can justify high PE ratio, but when growth slow, the market reprices and it's painful. Second, the debt load. $15 billion in debt. They took on massive debt to fund content during their growth phase. Now they are paying it down with free cash flow, but it's still a burden. Higher interest rate makes this more expensive. Competition is brutal. Disney Plus hit 150 million subscriber in under 3 years, something that looked Netflix over a decade. Apple has infinite money to spend on content. Amazon doesn't even need Prime Video to be profitable. It's a loss leader for Prime membership. Netflix doesn't have these advantage. They must make money from streaming. Their competitors, they can afford to lose money for years. Let me give you my honest take. If we assume $35 billion revenue, 12% profit margin, 20x earning multiply. So fair value comes to around $320 between 350 per share. But the current price, $400 to between $450. That suggests the stock is overvalued by about 20 to 30%. If Netflix can accelerate international growth back to double digit, increase profit margin as content scale, successfully monetize the ad tier, and maintain pricing power, then $50 could look cheap in 3 to 5 years. But those are a lot of ifs. In my rating, hold. The business is solid, cash flow is positive, but wait for pullback. If it dip to $320 to $350, but above $500, I'd be selling. What I actually do. 50% on Netflix, 30% on Disney, and 20% on Warner Bros. Discovery. This is the way you are betting on streaming as a sector without putting all eggs in one basket. What we learned today. First, Netflix business model, which is subscription-based revenue, $17 billion plus content spent annually, 247 million plus subscribers globally, and 12% profit margin. How content drives value. Big show reduce cancellation, global hits drive international growth, content cost scale across massive user base, and data-driven approach to hit making. Investment consideration. Currently overvalued by 20 to 30%, but strong cash flow generation is positive. Slowing growth is a concern, but competition intensifying. So international growth is the key to future value. Valuation. Fair value $320 between 350, but the current price is $400 between 450. So rating hold. Right now, Netflix is a good business at a fair to slightly expensive price. If you own it, hold it. If you are looking to buy, be patient and wait for a better entry point. If you found this breakdown valuable, do me a favor.